All right, so chapter 10 focuses on liabilities. All right, probably noticed that chapters 5, 6, 7, 8, and 9 were all about the assets. And now we're moving to the other side of the balance sheet with chapter 10 to focus on liabilities. Today we're going to be looking at current liabilities in more detail. And I think we'll have time to introduce you to the issue of bonds, and then we'll look at the rest during next time. So remember, a current liability is a debt that the company is expected to pay within the year, right? And it pays it from existing current assets. Okay. If they don't have enough current assets to pay their current liabilities, often they will borrow money or create other current liabilities, like a note. They'll borrow some money like this. So it's important that companies understand that they have to track their liabilities well. There are many more current liabilities than you're aware of. You've already been introduced to a lot of them, but there's actually a lot more. So you've already been introduced, for example, to notes payable and accounts payable. Those are very common. Unearned revenues are also very common. And some of those accrued liabilities that we talked about in the adjustment process, like salaries and wages payable, interest payable, things like that. So we will be expanding our view of this. First, a quick review of notes payable. Notes payable, as you know, is a promissory note. So the word note means loan. There's interest attached to these loans, right? Now, most notes are short term, so they might only last a few months or several months. However, some notes payable can go beyond the year. Um, and so that does happen. It's not as common as most notes payable, which are overwhelmingly short term. Okay. So remember, when you have a notes payable, you are paying everything back at the day it's due, on its due date. So that due date is going to matter whether we classify a note payable as a current liability or a long-term liability. But most of them will be current. So here's an illustration. First National Bank agrees to lend $100,000 on the 1st of September. If Cole Williams signs a 12% 4-month note, the maturity date is going to be January the 1st. So when the company issues this note, what's the entry going to look like on the books? Well, sorry, it's simply going to be a debit to cash and a credit to notes payable. That indicates that they've received more cash that day on September the 1st, but they've also created a notes payable for themselves. And that's all that happens on September the 1st. Okay. If they close their books on December 31st, again, this particular note isn't due until January 1st, which would make it a new fiscal year, an accounting year. So they would have to prepare an adjusting entry for all of the interest that accrued on this note that they wouldn't pay until the next period. So in this case, they would want to take the interest expense for the current year. So December 31st, you'd have the adjusting entry of an interest expense for 4,000. And they would set up an interest payable for 4,000, showing that they're going to be paying that, right, in the next fiscal period. The 4,000 came about by taking the $100,000, which was the note, times the 12%. Again, that is the annual interest. This is for all 12 months. We got it in September, so we needed September, October, November, December, 4 months of the 12. And that's where we got the $4,000 in interest. On the next day is another. It's a new fiscal year, so there'll be new accounting records. Right? they will pay the note back plus the interest all at the same time. So in this case, they would debit their notes payable for 100,000. They would also debit their interest payable for 4,000, and they would credit cash because this is the total amount that we were required to pay back both the loan and the interest on the loan. One of the things you need to understand is how important businesses are to the government in terms of collection of taxes. Businesses collect an enormous amount of taxes, and one of the more important ones is the sales tax. Now, not all states have sales taxes, but we do live in a state that has sales taxes. So that means that certain products usually are taxable, subject to the sales tax. So that means the employer, as the selling company, is going to collect money for selling the product, plus they're going to collect extra money in the sales tax. That sales tax is not theirs. They have to remit that to the state Department of Revenue on a regular basis. And so that sets up a liability called a sales tax payable. Right. So how this works is pretty basic. You got a date of March 25th. You got Cooley Grocery Store. They sold $10,000 worth of goods and needed to collect $600 of sales tax on that $10,000 sale. So they're going to collect all of that money, but they have to mark 10,000 as their revenue and the other 600 as a liability. It's a sales tax payable. So yes, they do collect a lot of cash, but it's not all theirs. They need to remit that, right, in a payable. So that's a very important thing that happens. Some companies don't ring up the tax separate, but there's ways in which we figure that out. So in this case, Cooley Grocery is ringing up a total of $10,600. Okay. The state has a 6% sales tax. So how much of that $10,600 is the tax? Well, we would take the 10,600 and we would divide it by 1.06. Right? So we would take the 10,600 and divide it by 1.06. Okay. And that'll allow us to separate the tax from the revenue that we're getting. So the revenue is 10,000 and the sales tax is 600. But the way we would do it is simply to divide by 1.06. That's 100% of the sales plus the 6% tax. So 106, 106% in decimal form is 1.06. That's how we would figure out if you get questions like that. We're very familiar with unearned revenue. You've been exposed to it since chapter 1. It's a very, very important account because it affects so many businesses. And again, just to remember that the customer is paying you up front, right? So you are collecting revenue before you deliver the goods or perform the service. So that's why it's a liability, right? Because you owe the customer whatever they paid for. So it's that's very important, and it affects tons of different types of businesses. Certainly in leisure and hospitality, from airlines and hotels and cruises and whatnot, you usually pay for those things up front. Entertainment venues are like that as well. Usually, when you're purchasing tickets to concerts or sporting events, you're buying them well ahead of time. So all of that is unearned revenue to those businesses. Very, very important. So how would it work when you have all of that unearned revenue? Well, it works in the case of a football ticket here, one game at a time. So here it starts at the very beginning where this Superior University sells 10,000 season tickets at $50 each for a 5-game home schedule. Okay. So they're collecting all that money up front. So they're going to collect $500,000 in cash, but it's all unearned revenue. So in this case, they've labeled it as unearned ticket revenue. That's their liability account. That's why it's credited. Okay. So again, it's sitting in the liability. When do they actually earn this? Well, one game at a time. So after every game is completed, they will debit unearned ticket revenue, which lowers the liability, and move it into their revenue account, which they've labeled ticket revenue. So again, this happens as each game is underway. Then they've actually earned it, and so they're going to make this entry. Okay. Understand too that there may be a lot of companies have long-term debt, but whatever is due this year of that long-term debt is actually considered a current liability. Why? Because it's due within 1 year. Okay. And so that portion of any long-term debt is going to be listed under current liabilities. The rest of that debt's going to be listed as a long-term liability. So here's an illustration. Wendy Construction Company has issued a 5-year interest-bearing $25,000 note. Okay. The note specifies that every January 1st, they will pay $5,000 of that $25,000 note back. So the company has financial statements that they're preparing as of December 31st, 2016. Okay. So again, 5,000 of the 25,000 is going to be paid within that first year. So what amount of that is current? 5,000. What's the long-term liability? The other 20,000. It's still a $25,000 note, but 5,000 of the note is due this year, so it's part of current liabilities. The remaining $20,000 is still a long-term debt, so it'll show up that way. Okay. So that's important to know. That's really important to know, and that's a bit of what this chapter starts out with. Okay. So here they have a few questions here. Here they borrowed $50,000 6-month 12% note on September the 1st. How much interest would be expensed by the end of the calendar year, assuming they use that as a fiscal year? Well, they have September, October, November, and December. Interest is going to be expensed for that particular year and paid in the following. So $50,000 is the note times 12%. This is an annual rate, so all 12 months. We're only looking at it for the 4 months of the 12, September, October, November, December. $2,000 of interest is going to be expensed in this fiscal year. And so we would go ahead and set up an interest expense for $2,000, interest payable. $2,000, that would be adjusting entry. Here we have the cash receipt is $23,320. That's total. And the sales tax rate is 6%. So how much of this is $23,320? How much of it is revenue? How much of it is tax? Well, you simply take the total and divide by 1.06. In this case, right? Whatever the rate is, it's 1.0, whatever the rate. So $22,000 of that is the actual revenue. The difference, which is $1,320, is the actual sales tax. And again, sales taxes are collected, but they create a current liability for the business called sales tax payable. Okay. And the last thing here that they want to talk about here, $15,000 is collected in advance, okay, on November the 1st for 3 months' rent. So if you collect that in advance, 15,000 for 3 months' rent, 5,000 each month. What are we talking about here if we want to recognize things by the end of December? Well, you've earned all of November rent and you've earned all of December rent. So you've earned 2 months of the 3 months rent. So $10,000 of the 15,000 is going to be revenue. You're going to make an adjusting entry for that. Like I was telling you, the employers, businesses are perhaps the best friends of government when it comes to collecting taxes. Not only do they collect sales taxes, they collect income taxes, okay, as well. So, so when it comes to payroll, it's very important to sort of understand where you're at. You could be hired either as a wage worker or a salaried worker, and there's very important differences between the two. Okay, if you are hired and they quote you an hourly rate, okay, then you are a wage worker. You're also considered what's called a non-exempt worker, which means that they have to pay you overtime for any work week in which you work over 40 hours. Okay. And so when we do payroll for wage workers, we have to be aware that um, the first 40 hours are at the normal rate. Any amount of work over 40 hours has to be at 1.5 the rate, 1.5 times the rate. That is not true with salaried workers. Salaried workers, you're hired at an annual salary, okay, or a monthly salary. That's how they hire you. So, all right, we'd like to hire you for $52,000 a year. Okay, well, then you're salaried. Salaried workers are what we call exempt workers. And that's because the law that establishes a 40-hour work week and overtime does not apply to salaried workers. Okay. So whether a salaried worker works 45 hours a week or 50 hours a week, they're still going to get paid the same salary. That's not true of a wage worker, where wage workers, if they are putting in 40 hours, 45 hours a week, they'll get paid. Those last 5 hours will be at a higher rate. Right? That's not true for a salaried worker. So payroll is very interesting because you need to know the difference to understand what the gross earnings are. For a salaried worker, it is simply that yearly rate divided by the number of pay periods. So if I hired you for $52,000 a year salary, and there's 52 weeks a year and payroll is weekly, your gross earnings is $1,000 a week. Okay. For a wage worker, I have to find out the hours that that person worked, multiply that by the rate per hour. If it's over 40 hours, I'm going to have to change the rate per hour for time and a half, and that'll calculate gross earnings. So that's the first step. Understanding that we calculated gross earnings is important. Payroll deductions is important to understand too, because there are mandatory deductions by law. Everybody has to pay into Social Security and Medicare. Okay. Together, these are called the FICA taxes. Okay. So 6.2% for Social Security, 1.45% for Medicare. So it's a big tax. 7.65% is the total tax that comes out of your check. These are mandatory taxes, mandatory. So you have to pay them as soon as you start working. Okay, it doesn't matter how much, even if you're only working for a day, you're still paying into it. So, so those are payroll deductions that are mandatory. Social Security, the 6.2% is to help fund the retirement plan that was created by the federal government many, many years ago to provide a basic income for the elderly. For your generation and my generation, you have to be 67 years old to qualify for full benefits. You can retire earlier than that, but you would be retiring at a significantly less of a benefit. Okay. But everybody pays into Social Security at the 6.2% rate. Medicare is basically when the federal government becomes a health insurance company to the elderly. Medicare is universal health insurance, and the only requirement to get Medicare is you have to be 65. That's it. It's paid for through this tax and provided as a benefit to older people. Okay, it's possible to be able to get Medicare prior to 65, only if you have like a disability and you're already collecting a Social Security disability check. You may be able to qualify for Medicare prior to that. But otherwise, you simply have to be 65. That's the only requirement. Okay. These taxes are we have to pay. If you're self-employed, of course, you're going to have to take this out of your own check, your own revenue, to put aside to pay your Social Security Medicare requirement. So those are required deductions. For most of us as well, businesses collect income taxes. And so the federal government taxes income. Taxes are income every year. And so we have to, for those of us that earn enough money that pay a tax, we have to have federal income taxes withheld from our paycheck. Okay. For those folks that don't make much money, they probably maybe just have a summer job or something like that. They can write in they're exempt from that. But that only means they're not expected to pay a federal income tax. They're not expected to. The same thing with state. We live in a state that also taxes income. And so the state of New York requires employers, just like the federal government requires employers, to withhold a certain part of our check as part of our payment for income taxes to the state. So when you look at your paycheck, you'll see a lot of different payroll deductions, but those are the ones that are mandatory by law. Okay, you'll see required by law FICA tax, so your Social Security Medicare tax is required. Depending on your earnings, federal income tax withholding, state income tax withholding is also going to be required. There are certain portions, like if you live in New York City, there's a city income tax as well. So that might also be required if you live in the 5 boroughs, or in Yonkers, which I also believe has a city tax on income. So it really depends on where you're living and those things. There's a whole bunch of other payroll deductions that are totally voluntary, whether you deduct money to go into a retirement plan, or you have money deducted for participation in benefits like getting health insurance or whatnot. Those are not considered mandatory. Those are voluntary. Okay. So lots of payroll deductions. The difference between the growth pay and all those deductions is the net pay. And the net pay basically is the amount of cash the employer must have available on your payroll day. Okay. Because those are in essence, those are the checks that are going to get cashed. All these deductions are going to be liabilities to the company. Okay. So that's very important to know. So how does it work? Well, here's an illustration of Cargo Company. They had a $100,000 payroll for the week of March 7th. So for the week of March 7th, they're going to take a salaries and wages expense for $100,000. However, as you see here, they are going to create several payables. The first payable is for the Social Security and Medicare tax. We call it FICA. All right. They also are setting up a payable for federal income taxes that are withheld and a payable for state income taxes that are withheld. So all of these amounts are separate liabilities. The FICA taxes and the federal income taxes are going to be remitted on a regular basis to the federal government through the IRS. The state income tax and any sales taxes is going to go to the state government's Department of Revenue. So the salaries and wages payable is literally the checks that they're giving to their employees that are going to get cashed. So that's really the only amount of cash they really need to meet a $100,000 payroll in this case. Okay. When payroll is actually paid out, you'll see that that payable will go away and cash will be credited by the amount of those checks. So the cash is only, you only need enough cash to meet your net pay. And in order to meet payroll, you're really kind of meeting net pay. All these other amounts are liabilities that you will remit on a regular basis to either the federal government's collection agency, which is the IRS, or the state government's collection agency, which is often the Department of Revenue. Okay. But you should know that employers have their own payroll taxes that they pay that you don't see. And so for businesses, a couple of things happen. Number one is businesses match whatever you put in to Social Security and Medicare. So for every dollar that comes out of your check as an employee into Social Security or Medicare, your employer is matching that on your behalf. You just don't see it because it doesn't come out of your check, but it is something that's a tax that has to be paid by employers. Employers also need to contribute to the unemployment compensation system. Okay, so there is a tax that's required for them to pay into the federal and state unemployment taxes. So unemployment benefits are when people lose their jobs through no fault of their own, like what happened during COVID, right? A lot of stores closed and they lost their jobs. They can apply for unemployment compensation at their state. The unemployment compensation application is approved. So where does the state get that money to pay those people? Well, it's from this tax. Okay. And the federal government collects a portion of it. And so as various states get hit hard, they can help those states with their unemployment compensation claims. That's where they get the money. Okay. I will tell you that right now they're just not collecting enough money, which is why Congress has to continue to pass these relief acts, because it's the only way the states are going to meet the obligations to unemployment compensation for people that are eligible for unemployment. All right, so here's an illustration of how that works on that same company's $100,000 payroll. Okay. Well, this is specifically the employer's expense. So they have to match the FICA taxes, right? So they're going to have the same FICA tax payable for every payroll as what employees have. And then they're going to be paying into the unemployment system as well. Okay. So the payroll tax expense here, you don't see, but businesses do, because they're matching all these things. Notice the federal unemployment tax is a much smaller rate than the state unemployment tax, because the unemployment compensation system basically is run at the state level with some federal support. Okay. And so again, that's how that works. Again, the FICA taxes and federal unemployment taxes are going to be, the business has to send these to the collection agency. They're going to send these to the, this is going to go to the IRS. The state unemployment tax is going to go to the state's Department of Revenue, regardless what state they're in, they'll all have the same. Okay. All right, so employer payroll taxes don't include any federal income taxes because that's not a payroll tax for the employer. All right, and so we finish learning objective 1 on this wonderful note of wage and payroll taxes. Woohoo! So here's the month of September. We have Lake Corporation's employees earned wages of $60,000. Okay. They had $3,500 in withholding for Social Security, $6,500 in withholding for federal income tax, $2,000 of withholding for state income tax. Additional costs to the employer includes unemployment taxes of $90 for the federal government, $150 for the state government. It is now September the 30th, and it's time to A, do the journal entries for the salaries and wages expenses for September. And then after that, we'll do B, which is the company's payroll tax. So first up is A. They had $60,000 payroll. That's what we have here. They have several payables, right? The $3,500 in FICA tax payable, the $6,500 in federal income tax payable, to $2,000 in state income tax payable. So all of these are payables. That means they have a payroll of $48,000 that they have to meet. Okay, at the end of September. For the payroll tax, again, remember, they have to match whatever their employees put into Social Security, the FICA tax, they have to match that, in addition to the unemployment taxes. And so here at the end of September, they will have a payroll tax expense of $3,740, which includes the $3,500 match for FICA taxes, $90 in federal unemployment tax, $150 for state unemployment tax. Okay. And I'll stop right there to give us a break.